Merhaba, everybody. How's it going in Istanbul? How are you feeling? Woo! Good, good, good. I want to have some little exercise before I roll in, okay? I want you to put in front your right hand in front of you right now. Just do this with your right hand, okay? Do this with your left hand. Now put them all together. Repeat it a couple of times. And congratulate yourself on surviving the bear market of 2022. My name is Adrian Zduńczyk. I'm a CMT chartered market technician, and I'm here to talk to you about the 3 master charts to consider for this Bitcoin bull market. And I want to start off by saying that we know nothing. We cannot possibly know every single thing that is going on around us. It's impossible for me to know who's going to win the elections this week, okay? I don't know what the Bitcoin target is. Don't ask me that. And I watch just half of the room just probably leaves right now. I don't know the Bitcoin targets. I don't know possibly most of the things that is going on in the world that are going on in the world. And because of that, we have to accept the fact that we are objectively ignorant. And the more we try to predict something into the future, the less certainty we have, the more uncertain we become. And this uncertainty is often a reason for our irrational behavior. And our irrational behavior is also a source of noise. It's an unwanted variability that makes us disagree with ourselves. So depending on our mood, the way we wake up, the way we feel, perhaps it's Monday, maybe you hate Mondays. Anyone else would just, love Fridays in here, for instance? Raise your hand up. You love Fridays, guys? You love Sundays? You love Saturdays? So perhaps you have a special attribution towards this given day of a week that you like more, that you're feeling more energized. Some people I know hate Mondays. I'm not this type of a guy. And this inconsistency makes us deviate from our typical actions and plans. And there is a thing that is called the linear model. And the linear model basically is a system of very simple rules that make us act better in the uncertain world by repeating certain steps and actions. And each and every single time in those terms, because there is so much uncertainty, so much stuff that we cannot predict, by having a very simple rule, or 2 or 3 rules, very simple ones, as in, imagine you hate Mondays, so you're going to wake up every single Monday at 7 a.m. not to give yourself a reason to wake up later, right? Or that you always, they always have this kind of like a custom on the exchange that they ring the bell, on the floor of the exchange they ring the bell, some kind of like rituals, customs. So those guidelines, those rules help us perform better. And one of that example of rules and guidelines can be found in the study word that we call otherwise as technical analysis. And technical analysis is not a set of squiggly lines. It is not a crystal ball to predict the future. It is not to give you the target for 10 years from now for Bitcoin. It is barely enough of a toolkit to help you manage the risk. And that's it, with the help of charts and indicators. So it is never 100% guarantee win. It is never resistant to market manipulations. It always takes one tweet from Elon Musk to crash the market, to pump NFTs, to do whatever. It's very, very dependent on what's going on, especially from those big opinion leaders like Elon Musk. It is not a crystal ball to predict the future, so do not expect it to give you an answer what the weather is going to be in 5 years from now on Mars, or what the price of Bitcoin is going to be on the same day 5 years from now. It is also not a set of squiggle lines. So moving on to why it works, why it is credible, we have to understand that we act irrationally, and at times our irrational behaviors have directions. And those directions come up in the charts as trends, as those directional movements, price movements that tend to persist. This is a confirmation, and existence of trends is an exact reason for why the price movements are not random. Otherwise, you would have basically 50% chances that the market goes up or down, right? So if that is so-called a random walk, and if the price movements would be random, if they are random, then how it is possible for Bitcoin to move up for 3 years straight up? If they are so random, then what is the chance that completely randomly, by chance, Bitcoin is going to go up or down for a year long, like it does in the bull markets and in the bear markets, right? So the existence of trends is a direct proof that technical analysis works, that the price movements are not random, that the price has memory. And it does so also because the trends are fractals. And fractal is this kind of like a funny overused word that is actually deeply statistical and mathematical in nature. And it does regard the nature of self-complexity. So trends are self-complex objects, figures that are present in real life. For instance, there is no presence of actual idealized objects in the world around us. It's impossible for us to, let's say, I'm 175 height centimeters, right? So the chances that I'm perfectly 1.75 meters is very low. I'm probably 1.75003, right? But it's never going to be perfect. It's never going to be ideal because the ideals are not existent in the world. And there is a thing called coastline paradox that basically makes it pretty funny that if you try to measure a coastline of an island, of a country, right, of a state, of a border, then the length of the country depends on the actual size of the ruler or the measurement that you're going to use. And the smaller the measurement you pick, the bigger is going to be the size. This is pretty interesting. And the trends are fractals as well. Many things in the real world are fractals, right? So they are self-complex, and it depends on the measurement that you use that is actually going to give you the real value of that. And trends are fractals, and what it means that they are complex, that there is not a single way to tell you that Bitcoin is bullish or bearish at one point, because it can be bullish, bearish, and neutral all at the same time on different time frames. So depending on the primary time frame, if that is your scope of interest, you can differentiate the bull markets and the bear markets. And even in the bull markets, the corrections are existent. So it can be bullish on the major time frame on a primary trend being a bull market, and it can be bearish temporarily. And it can be completely neutral due to the amount of noise on the lower time frames. And one of the most important points and principles for why technical analysis works and why it can be profitable is that the trend is your friend. You don't want to oppose big trends. And ever since 2023 started, we're looking at a new trend that I otherwise call the fifth bull market. And if you have a look in the past, knowing that price is memory, that there is certain correlation between what happened and what is going on right now with the Bitcoin prices, then you can actually notice that one and the same pattern that took us to the new all-time highs and actually kicked off the new bull run legs is present with us right now as well. We are talking about the midterm election in the United States that always take us on the sideways kind of like a movement, or negative, which is basically translated to bear market. So 2022 was a midterm election year, and it fitted perfectly basically in the frames of this midterm seasonality. So we had a bear market that this thicker black line is a 200-day moving average, basically representing the bull market or a bear market. If it declines, it's a bear market. If it inclines, goes up, it's a bull market, and there is no question about it because it tells you about the consistency of 200 days of movements. When you apply 200 days of movements and the line goes up consistently, time after time after time, day after day, that's not random. So it informs you about the actual directions of the primary trends. And the actual breakout over $20,000, that was at the time the fair, call it true value of Bitcoin, according to the average. It happened, it broke out. There was an actual breakout, and this breakout was confirmed across all the techniques that you can find in technical analysis world. So we could find confirmation on the technical levels. We love to frame our minds at the round numbers and anchors, basically. Be $20,000, $30,000, they were all broken. We've seen 100% rally to the upside on Bitcoin. So if a coin of a $500 billion market capitalization size moves 100%, can it really be an accident? Of course not. We got a confirmation for volume, for breadth, how the overallness of the market moved up. We've got a confirmation of increased volatility in the time. We are staying above the 200-day average, the bull market trend, for the past 4 months. Is this an accident then? It's not coincidental. So the bull trend, that is the conclusion, is confirmed. It's a fact. It's not my opinion. I'm just looking at a chart and I'm telling you that this is a fact, because that's what the chart tells me. So speaking of the next point, that is a seasonality. I read this excellent book, or worksheet if you want, Stock Traders Almanac for this year by my good friend Jeff Hirsch, who is an excellent seasonality strategist. And 2023 happens to be a pre-election year in the States, and those presidential cycles often move the markets in one direction or another because politicians want to get re-elected, so they will often move the markets to make everybody feel better and more engaged, more encouraged to vote on them. So it's very unlikely for presidential cycles to change as long as there is a 4-year cycle for the election. So that the pre-election years, and 2023 happens to be one of those, are historically the best performing years on the record. And we're not talking about the 5 days or some random like last week. We're talking about 84 years of data. And in 84 years of data, only once pre-election year was a loser. It means that 83 out of 84 times pre-election year was actually a winner. So we have 80 or 98.8% of chances that if you bet on bullish close of the year so that the year closes higher than it opened in 2023, that you're going to be right about that. So if you have 80 or 98% of chances of winning, would you take the bet on the opposite? So only one loser in 84 years, let that sink in. There's also a thing called the January barometer, which basically says that as January goes, so goes the year. And if the January closes bullish, there is a direct effect with 83.3% chances historically over 72 years that it's going to translate to the same sentiment about the rest of the year. If the January closes bearish, lower than it opens, which it did last year, we got a bear market, so it fitted perfectly in that. And again, 72 years of data, that's 3 times as long as I live basically, right? So again, 83.3% of chances, it's a lot, okay? So we have less than 17% of chances of being right if you want to bet opposite. So long story short, being a bear in 2023 is like betting on negative temperatures in the summer. Even though you don't know the future of the prices, you don't know the future of the temperature as well. It's pretty cold right now. I'm wearing my hoodie, okay? So I was expecting a little bit hotter temperature, bigger temperature, if you will. Typically in the summers, it's hotter than in the winters. Do you agree? In the winters, temperature goes lower than typically goes in the summer. So what is the logic and intelligence behind claiming the opposite? So what are the chances that, even though we don't know the future, that what are the chances that you're going to freeze in the summer? They're pretty low. There is a chance, but they are pretty low. So same thing with the prices. So how many of you have ever heard about Isaac Newton in a school? Right? Oh, not so many, okay. Isaac Newton, the physicist. So I've got a little bit of a short exercise. So Newtonian dynamics. Imagine 2 vehicles, a car and a truck, just move with the same velocity or speed, 100 kilometers an hour, and they crash into a wall. So which one is going to cause more damage? Raise your hand if you think more damage is going to be caused by number 2. Okay? And raise your hand if you think the more damage on the wall and a crash is going to come from the vehicle number 1. Okay? So the velocity is the same. What differs is the mass. And imagine that the trends in the markets are an actual speeding truck. In the same way that you have a momentum principle basically giving you a product of mass and velocity that is giving the damage. It's not the velocity itself, it's the mass and velocity is the product. So we can compare it in a similar manner with the market capitalization, the mass or the size of the market, and its actual slope or velocity. So if you have a big market like Bitcoin of $500 billion capitalization moving aggressively very fast to the upside, You're basically putting your body in front of a speeding truck, hoping that it's not going to run over you, that you're going to stop it with the force of your body. It doesn't make sense, does it? And that translates to momentum principle, that basically says that the outperforming assets, the ones that are like those big speeding trucks, the ones that are having lots of momentum, lots of mass and velocity, are going to continue to outperform, and the underperforming assets will continue to underperform. And that translates to momentum investing, which is basically a strategy or portfolio management tactic of longing the strength and shorting the weakness. So you search for the strong players and you long them, you search for the weak players and you short them, because you assume that the momentum principle is going to run, let them continue running in those directions. And that also gives you a direct anticipation about the market behavior, and because we often act irrationally out of fear and greed, we tend to cause positive feedback loops. So if everyone is buying, you're going to buy as well, because you feel pressure of missing out. So we contribute to this positive effect on the price. And so the other people do the same, and they join in on the bandwagon, pushing the prices even higher. And this is exactly what takes us very, very high, and way higher than anybody can probably expect in the bull markets, where everybody's making money, where everybody's euphoric, everybody and their dog and the dog's goldfish is making money, and they really tell everybody, call their family to buy Bitcoin and so on. And they often do that because they see everybody else is missing out. So they are actually not to miss out, to join, this game, they're going to buy in. And similarly and inversely, what happens in the bear markets is that they were going to sell off because everybody else is selling off. So you basically are looking at these positive feedbacks and increased effect that gives you overshot targets to the upside and overshot targets to the bottom. And by observing the sentiment of traders, by the way that they react to the facts, you can observe the market stages. And the facts are that the Bitcoin bull market has started. Those are the facts. This is not my opinion. The trends are moving up. This is what the market is telling me. That's not what I think it's good or bad. It's just the way it is. It's a fact. And if many people reject the facts in the name of their previously held views, then this is what we call disbelief. And the greatest amount of cognitive dissonance is experienced during the early stages of the reversal. And because of that, the more disbelief, the more irrational rejection of the facts, the more denying of the facts. So you're looking at the trend going up and you say, okay, this is going down to me, even though the line is straight up, right? This is the minds playing tricks on us. And this is very popular in disbelief. So putting everything together real quick, you want to retake away that the trend is your friend, that you don't want to oppose your body weight against the speeding truck. It's very full of damage if it happens. UMD portfolio, which means basically up minus down. This is the momentum principle again. So you want long strength and short weakness, and you want to remember that, not countering those long-term seasonal trends. You want to respect the market cycles and understanding that whenever there's big amount of rejection of reality, of cognitive dissonance that is conflicting our views, and we would deny the facts, then this is probably disbelief. And sprinkle it all with a little bit of patience, and it happens that trading can be profitable. Thank you so much. Teşekkürler.